All right. Good afternoon, everyone. Rich Swerbinski with TMC here once again with the last week in mortgage today, our weekly walk through all the latest happenings in the mortgage industry. And each week I am pleased to be joined by one of our lender members as my co-host. And this week, one of our most popular network contributors and always a guy that's going to bring a lot of insight, the Chief Lending Officer of PRMG, Kevin Peranio. Kevin, thanks for joining me.
How are you doing?
Doing good, doing good.
Happy to be here. Am I nice and centered? I got my nice little background, my virtual background from PRMG today.
Look at that. And what company pride. I love it. So no, it looked good. And thanks again for joining us. And yeah, certainly no shortage of things going on in the mortgage industry. Always enjoy getting your insight on everything going on. And as always, for our attendees, any comments, questions, thoughts, jokes, anything, please feel free to just bring it in the chat or the Q&A, and we will go ahead and voice it aloud. So KP, want to start out by just getting your general thoughts on the year that we're now a little over a quarter into. Been a good start, I think, for the year, coming off a record year for the industry, over 3.8 trillion in originations last year. MBA's official projections, their most latest for this year, is about 3.3 trillion. So down roughly 14% from last year. I think within that, they predict purchase activity up 16.5%. They predict refis to be down about a third. And rates to slowly trend up, the 30-year fixed rate to about 3.7% throughout the course of the year. Now that we're a little into it, what are your general thoughts on the outlook for 2021 broadly as an industry for us?
Well, I've been using this phrase, we start 21 on the run. Last year, about a year ago, we were just coming off a record April because of low interest rates due to the Fed's actions. I think for most companies, April was probably the best month any company ever had in their history. For us, it was the first time we'd ever eclipsed $1 billion as a company in a month. We did 1.35. And then May was a little bit of a pullback. And then, this year, January, February, March, all of them over $1 billion each for us. So we started off this year with a carryover of last year. So I think the first 6 months are in the bag this year for absolutely stunning numbers for everybody. And that's a good thing. It doesn't feel as hectic. It doesn't feel as crazy because, when you build up for an almost $4 trillion year and then you're only going to do whatever, MBA projected, you said 3.3 trillion, all those numbers obviously remain to be seen. But, it's not as busy because you've staffed into it and you've leaned into it. And so it doesn't feel as hectic, but we're still very busy. But the underlying theme there, and I talked about last night on my LinkedIn video, is going to be margin compression. And so we may be doing a tremendous amount of business as a company. I mean, some of us might have our second best, most of us should have our second best year ever in our existence. But the profitability might not be as good as, even 2019. So it just depends on, your model and your efficiency and your cost structure. But I think that's the thing. All those projects that we've been working on, all the vendor partners and all the initiatives that TMC and all of our leadership teams have been working on together for years, where they matter most was not last year because it's more about human capital, it's more about bodies. This year it matters as far as profitability because it will start to get razor thin as the year goes on. And did you grasp onto RPA and AI? Do you have any kind of offshoring? Do you have a good secondary model? Do you have all the things that get that cost per loan down? And, then we'll all start having hard conversations, later on this year and into next year. To talk about LO comp, we talked about margins for branch managers. I mean, every one of us who runs a lender, we only can go so far, and we have our floor of what our volume needs to be profitable. So all the tough conversations will be happening in the fall and the winter if they haven't already started. And that is really the undercurrent and the things that we're looking at and we're working on right now and through the end of 2021.
So true. What you just mentioned, projects, vendors, tech initiatives, everything that lenders had planned for last year kind of got pushed to the back burner with first the uncertainty of the pandemic and then just the crush of volume. And certainly that's what we're hearing from our members. They are just right now, they're still busy, which makes it a little bit more complex. Good thing, good problems to have, but really hyper focused on whatever the top corporate initiatives they had that kind of got pushed to the back burner for last year. Margins, I want to get into that a little bit more. I know you guys have a wholesale channel. I'll get into that in a little bit. Your retail channel, though, in general, what we're hearing from our members is they're starting to feel margin compression, but it's coming from a place of very lofty margins. They haven't felt it dramatically yet. They feel like, rates have come back down, pretty significantly here in May. It's led to a little bit more refi. They feel like maybe that's helped, one, volume in general, and two, maybe the delay of the inevitable margin compression. Is that what you're seeing on your retail channel?
Yeah, the retail channel, the pricing complaints haven't been really that crazy. Obviously you have some states where traditionally margins are always thin, like Texas, for example. Texas is just a price-driven market. I'm from there. I'm from there originally. I'm born and raised in Dallas, and I started at First Magnus back in 2001 in this industry in Austin, Texas. Texas has always been razor thin on margins. It's just super competitive. Their collateral is highly coveted in the secondary market. People get 30-year fixed, full doc, come hell or high water. No one's taking a home. They're going to pay that thing if there's their last nickel in their pocket. They're paying the mortgage. So it's just a very competitive market. But not all markets are like that. And so I would say, as far as the retail channels as a whole, that conversation will continue to evolve again as volume comes down. But then you just got to take a step back. What is the value proposition? And I always talk about the old adage in any industry. It's cheaper, better, faster. Pick two. You can't be cheaper and better, but then also faster. But if there's anything that Amazon has tried to solve, it's that you can be all three. And so I actually rearrange those words purposely. I say better first, then faster, then cheaper. If price is your number one value proposition, then you could go fight the fintech battles with all the dudes that are putting billions of dollars together, and they just want to say, go to my website and slam through your stuff. But how does that help a home buyer? How does it help a first-time home buyer? How does it help someone that needs, massaging of the deal? Where's the value? Where's you being local and providing a product? And it's also competitively priced, plus you're fast. So the bar for us in our retail channel, in all channels, is to be better, faster, and cheaper. And that value is on us as leaders who run our lenders to make sure that our retail originators want to stay with us, or else they will go somewhere else.
Very well put. We had a question come in the chat that actually takes me in the direction of where I wanted to go next. The question is, what challenges are you having with delivering investment properties and second homes to the aggregators or the GSEs? Certainly that was big news, kind of bestowed upon the mortgage industry with little to no advance notice. A lot of our members, had 20% non-owner in their pipeline, scrambling to adjust, rumors of more changes potentially coming as Mark Calabria may or may not be facing the end of his reign of terror at the head of the FHFA. How did the non-owner changes affect you? What are some of the things you've done to mitigate that? And then more broadly, what are your thoughts on just everything going on with the GSEs right now at the direction of FHFA, which is largely contrary to a lot of the other messaging and agendas and direction of the Biden administration's broader housing policy?
Well, I personally haven't talked to anyone directly with Fannie and Freddie, but I hear a lot. Obviously we have a leadership team, and so I'm providing cover for Fannie and Freddie right now. But look, we're all run teams here, and we know what it's like. When you have failed leadership, you go join another team. That happens to our branch managers in the retail channel, and that's happening at Fannie and Freddie. Look at everyone leaving Fannie and Freddie. These people have been there for, some of them, decades. They're leaving. Why? Because it's a nightmare. They're being asked on a whim to change, decades of history and precedent setting. Does anyone think that a second home is suddenly that much more risky overnight? No. Could it be later? Yes, it could be potentially. But again, the mission that the FHFA has, and specifically Director Mark Calabria, he's still trying to carry out his mission that he was tasked with the prior administration he is trying to make sure that they recap and release Fannie and Freddie and take it private. So whether you agree with that mission or not, whether you agree with the addendums to the PSPA that came out, at the 11th hour in January when there was a, transition from one administration to another, he's working on that mission. And, he's a super smart guy. He's been in the business for, a long time. He's in the weeds and he's doing what he was hired to do. It doesn't sit well with everybody. It sucks for us overnight to have to find a way to, get rid of our excess 7% of Fannie and Freddie second homes and non-owners. It's hard for us. Okay, I guess we got to start securitizing loans now. Can't sell the cash window because suddenly there's the GSEs that have had a mission to provide liquidity are suddenly not providing liquidity to the cash window. There's only liquidity provided to the way that the banks are more favorable for because they have the bigger balance sheets because you have to hold the asset for a longer period of time, which comes with risk, as we saw a year ago. So it's very hectic right now, and everyone is upset. There's no one that's happy with the pace of change. And to quote the Mortgage Bankers Association, they've been asking and lobbying with FHFA for a longer runway. They need more time to implement and institute this 7% cap. Now, for us, we're fortunate because of our size that just our numbers is about 12%. Okay. So we take 7%, we sell it to Fannie and Freddie, and then we work out the rest with our large aggregator partners. We have long-standing relationships, and it has worked out for us. But we don't want to be adversely selected and take an inflow of everyone else's second home and non-owner business. So of course we had to add a hit. I think we added a 50 bip hit initially for second homes in our retail channel. Took care of our people first, and then wholesale. In correspondent channels, I think we're at 2 points, and obviously the non-owners are much higher than that. So, we took care of our retail channel first on that specific instance, just like we did last year. There are some really large lenders out there, between UWM and Rocket and Home Point and Calabria, aka now New Res, because they all got sold over to another hedge fund backed company. We don't want their overflow. They're much larger than we are. As big as we're getting, and we still act like a small lender. If we put out a good price, we will get flooded, and we'll be at 10, 20, 15% before we know it on second and non-owners. So we had to, just like last year, we had to raise margins in our TPO channels higher than we raised our margins in retail and took care of our own people. We're doing the same thing with the hit for second home and non-owner, and that's how we're navigating the waters that suddenly are rocky again in what's supposed to be, a nice orderly recovery coming out of a global recession pandemic.
Thanks, Kevin. This is the last week in Mortgage Today. I'm Rich Swerbinsky with the Mortgage Collaborative, joined this week by Chief Lending Officer for PRMG, Kevin Peranio. Kevin, any speculation, thoughts? There's a case, obviously, in the Supreme Court right now that stands to potentially figure out a few different things for the GSEs, the fate of the stockholders, and, if the presidential administration would have the latitude to replace the director. It feels like most people in the know feel like it's likely that the Biden administration would be able to make a change to the director, once that case is resolved. A new director obviously would probably be in store if they have the ability to do so. And it seems like, right, would the most likely path of a new director be still guiding the agencies towards exiting conservatorship, but maybe more the way it's been done in the past, more runway, more laid out, maybe some flexibility in and around the 7%, delays of some of the other stuff in the PSPA amendment. Do you see that as the most likely scenario if Calabria is replaced?
Well, it's all about checks and balances. I mean, our entire framework of our republic is based on checks and balances. And where's the check on this power? I mean, potentially, I don't know, I'm not behind the scenes at FHFA, but potentially one man taxed the entire American homeownership via, an adverse market fee of 50 basis points on refinances through Fannie and Freddie. One person could have done that. Now, I'm not saying he did. He's the spokesman, he's the leader, he's the face. So in essence, that's what it looks like. It may have been, a healthy discussion and everyone agreed on it. I don't really know. But our government, our republic is based on checks and balances of power. And if there is no check on an individual that can have that kind of power, a taxation without representation, which is, literally, we went to war over that, So I just don't I don't see how, after a precedent being set already with the CFPB director that you don't need to be fired for cause, you can be fired at will by the administration. Why wouldn't the administration have oversight on a government agency that has so much power in one person? Or else there'd be no check and balance on that power. If you notice, Treasury has been very silent. They haven't said anything about anything. They aren't talking about anything that we're talking about. They're waiting for this case to be settled before they decide what to do. That's what's happening. I don't know that for a fact, but that's just my intuition. No one's told me that, but I mean, their silence is deafening. So, and it speaks volumes as far as what they're doing. So I think the precedent was already set. We have a Supreme Court that's now is constitutional jurist leaning. Don't believe all the hype about the politics that, oh, Roe v. Wade's going to get thrown out just because everyone's so-and-so, like all that kind of stuff. It's about the Constitution. It's about the framework. It's about following the rules that was set to create our republic. So, do states have the rights to make the decision? Yes. Are there checks and balances of power, like, for example, a one-person single director in a government agency? Yes. And the precedent's already been set in the Supreme Court. So I think Treasury's just waiting for that outcome, which is supposed to come no later than next month. And then we'll see, I'm sure, going through the summer, some sweeping changes in housing and policy.
Kevin, we recently conducted a very comprehensive survey, sent it to yourself and about 600 other key kind of hand-picked leaders and decision makers from within our 230 lender members across America, seeking to take their temperature, their pulse on the current state of the mortgage industry, the issues that are most top of mind to them as we head into the heart of spring buying season, going off the heels of a record year, really a very tumultuous climate right now, a lot going on. One of the issues that catapulted up the priority list for our members from the last time we did this is just fair lending oversight, and for good reason. The new iteration of the CFPB really has been banging this drum pretty hard since they took control of that office, seeking a fair playing field for all home buyers in America, and really making sure that, everybody's getting the same opportunity to borrow money and finance the American dream. Just in talking to our members, our depository, just as old hat, as somebody that ran lending for a depository, I think I went through 4 fair lending audits my last 6 years at the bank I was at. Our depositories are like, yeah, I know, this is what we've been going through. Our IMB members, though, it's caught their attention, and talking to them over the course of these last several weeks, it's an issue that they're kind of scheming around behind the scenes, and starting to develop policies, procedures, reporting. How have you guys viewed the issue at PRMG? Is there anything that you had done in the past that you're just continuing to do, or that you've implemented recently in anticipation of more regulatory oversight, especially as it relates to fair lending and fair housing?
Well, I mean, everything, revolves around taking care of the consumer. And as long as everyone's doing right by the consumer, and you have controls and measures within your organization to ensure that that happens, and when it doesn't happen, that you were able to recognize it, self-report, and then correct whatever happened, if anything happened, then I don't think anyone has anything to worry about. I don't buy into the hype of media and people that politicize, and most of the voices that yelling the loudest, they have an agenda on their own, or they're very extreme ideologue, one way or the other. And of course, in the media, it's all for clicks, right? So, we have tabloids in our industry, and the headlines always get to click it. The reality is, we do have a tougher administration, and when it comes to enforcement action, they've said as much. I want to see what they do. Our actions speak louder than words. We're dealing with politicians. We're dealing with people that need to cater to their base. We're dealing with people that want to get reelected, in 2 years or less than that now. So what I want to see is, what are the actual enforcement actions? And so obviously the last 4 years, the CFP director, Kathy Kraninger, it was a very laissez-faire attitude, but they did have enforcement actions, and they went after people that in organizations that, did wrong by the consumer. And everyone looks to those enforcement actions the last 4 years and goes, yeah, that was pretty crazy. Let's look at the prior administration. when the CFPB was created? What were the enforcement actions then? By and large, the ones that really impacted the mortgage industry were False Claims Act lawsuits. So, I can tell you, through experience that if you self-report and you do right by the consumer, you're not going to have anything to worry about. And I will tell you that is the key to making sure that you don't have some big multi-million-dollar lawsuit creeping around the corner. And so again, from what I've read, they want to go after the worst of the worst, debt collectors. I mean, all the phone calls that people get out there, the harassing credit agencies. If you are a servicer and you're getting a lot of complaints, you may get on the radar. Those are the things that you have to watch out for, I think, on this call, or else most of it, in my opinion, is hype until I see some actual enforcement actions, and then we can read the tea leaves. And I'll just leave on this note. I remember I was at a NAM trade show, excuse me, in Las Vegas about, oh gosh, maybe 7 years ago. And there was someone from the CFPB there, and they were talking to a room, and I just stood up. I said, hey, why don't you just tell us what your interpretation is of the rule instead of bust us afterwards and then say, there isn't a lender out there that doesn't want to know what to do. Just tell us what to do. Tell us what to do, and we'll do it. And then you don't have to worry about busting anybody. That's it. Just tell us exactly what you think is right and wrong. Just tell us, write it down, tell us. But, they didn't have that attitude. It was a whole gotcha environment, back in, that early days. And so I hope we don't go that far back to the gotcha environment where they're just looking to bust people. And that's just stupid. That doesn't do anything. You're actually allowing people to get harmed in the process before you then take someone to task and then bust them. Tell us now, so no one ever gets harmed, or else, you could go on to say that maybe they're even implicit. So, when it comes to vague interpretations of regulations, I think that's where we could use some great outreach from great organizations like TMC and some others that I'm involved in to get interpretations of things that are still vague. Because nobody wants to do wrong by the consumer that I know. Nobody in TMC. No one I know, I don't know any fraudsters that want to purposely go out and hurt consumers. If you think we are, let us know, and then we'll work through it.
This is the last week in Mortgage Today. I'm Rich Swerbinsky with the Mortgage Collaborative, here with PRMG Chief Lending Officer Kevin Peranio. We've got about 6-7 minutes left with Kevin. Any comments, questions, thoughts? Feel free to type them in the chat or the Q&A, and we'll voice them aloud. Kevin, Redfin came out with the report, I think it was yesterday or today. 75% of homes over the course of the last month involved in some sort of bidding war that I think was defined by more than a handful of offers above asking price. Kind of batty what's going on right now in the housing market. Values are obviously moving upward at a very healthy clip. A couple different schools of thought regarding home values. One is that they're inflated and there's going to be a big correction, and to what severity, the opinions are divided there. There's another that is, listen, one of the byproducts of the pandemic is homes and housing it became more valuable because people find more value in their home. And this is an increase that you may see a leveling off down the road, but no correction. What camp are you in as it regards to just home prices nationally in general?
Yeah, I'm definitely in the latter camp. I mean, there's no bust, there's no bubble, there's no crash. It's not coming. 2008 is calling, and they want your mindset back. Like that was so long ago. I saw a crazy stat that for pretty much every decade of time, there was 20 to 25 million homes created, the new construction homes in a decade, right? So in the 2010 to 2020 decade, it was something like 5 million new homes are created. I mean, something crazy. I mean, so there's the supply aspect of it, right? Obviously, we have a wave of demand because of low rates, but rates are going to be relatively low. We may never see a rate above 4.5% ever again. The Fed, our federal debt and deficit, we can't afford an interest rate that high. So I can't imagine how much higher it will allow to even go. The demand will be there historically from rate perspective, but this is the thing that nobody talks about. Logan Motoshami over at Housing Wire does a great job of this. He was a great housing analyst for years, and then Housing Wire noticed him and then scooped him up on their payroll because he really knows what he's talking about. This is a demographic wave. This is a demographic wave. The first-time homebuyer age is 33. For like 7 years in a row, the number of people that turn 33 every year goes up and up and up. This is a massive demographics wave heading at the same time a housing supply shortage is hit, meeting with historically low interest rates, which are going to remain historically low. So, people just buy houses, and our population is growing. It's not, growing by leaps and bounds, but we're still growing. The census data shows that there's population growth. So I just don't see anything happen. The only thing that would disrupt this, is if, like those 3D printed homes, or like the super fast, incredibly quick constructed homes that are quality and that people like, and that maybe have a smaller footprint and a smaller price point, that would drive demand and bring the median home price down. That is the only thing I see that could create a crash, if you will. And that's going to take years to happen, because the builders got absolutely annihilated in 07 and 08. There was no bailout for the builders. They only bailed out the banks and the lenders. They got crushed. So they have been taking their sweet old time building new units because they don't want to get crushed again. And why not? Look at the profit they're making. They're killing it. So this is going to go for years. I mean, at least 2 years before, if anything, a leveling off. But again, I just don't see a crash unless there's some disruption coming into the construction business.
Kevin, about 15% of our members are like PRMG in that they have some sort of wholesale channel. For some, it's just small. But what we've been hearing from those members is that it's a tough market right now, just because, you've got UWM and Rocket, both recently went public. They're obviously sparring verbally and privately and jockeying for, that kind of that top spot. And both are priced very aggressively in that quest, making it tougher on those in the next tier or tiers. Is that what you're seeing in your wholesale channel? What is the margin climate there right now? We've had some others that have said they've had some success starting to recruit brokers to become bankers again, just because some feel like the mindset is that the wholesale channel is moving away from one where it's price and choice and more of like mini branches for these big giant wholesale lenders. Would welcome your thoughts and perspective on all that.
Yeah, I'll kind of start macro and then zoom back into what we're doing specifically as a 3-channel lender. I used to work for Dell Computers in 1999 when I lived in Austin, and I went through a cycle. I was there at the end. When I first joined, I only worked there for 18 months, and I worked in the home sales division. So sat there, age 22, my headset on, you'd see the commercial, dude, you're getting a Dell, the little Steven guy, the little smoker, and then you call in, and I was on the phone. So, we were selling computers for $2,000 to start. Tag a printer, tag on financing, tag on a warranty, and then if you had a high close rate, like I did, I had the highest close rate out of 800 reps. I won all the trips. Yay. Well, about a year later, Michael Dell said, why do we have 10 computer makers? Like, there's no reason for me to allow this competition to happen. I have a great systems in place. I have an assembly line. I can crush my competition. We're going to sell computers for $499, and we'll just see who's left. And one by one, you don't hear a Gateway, HP Compact, they combined. Acer came out of nowhere because they're the cheap one. So I've lived through this. And so I think the thought at Rocket and UWM is that they are going to just crush all the competition. And so, but here's the thing, it all comes back to value. If their systems and their price and their product mix is good enough to give, let's say they max it out between the two of them, 50% market share in the next 5 years. Okay. I think that is probably 50% market share in a $1.2 trillion a year market. There's only 600 billion for everyone else to fight for. So, where do you carve out your niche? And so I think where UWM has an advantage is because they've dealt with local people. Winning local is the way you beat fintech. So we're all local lenders here. Rocket is like, I think I read somewhere in their public thing, they're like 90% refi. They're trying to build their wholesale channel because they need those local purchase money hunters. They don't have that. The fintech is getting so good for us and our members here in TMC that we can fight with them on a technology standpoint. We can provide value and be local and have our own membership and our own leadership and our own culture where we work. And we can also provide optionality. Optionality isn't exclusive to the wholesale channel. Here we have literally 7 different points of sale. 3 of them you can only get at a wholesale, at an enterprise lender like us. You can't get when you have to pick the just one. So we have optionality. We have multiple CRMs. We have multiple ways of getting leads. We have multiple lead flow. We have multiple everything. We have optionality within our own walls. And then we have an awesome vibe and a cool culture. So that's how we're fighting, on the retail channel. Now, having said that, we also have a wholesale channel, because I think really the difference is either you're a cowboy, you're an entrepreneur, you want to go work for yourself and you want to have your own business and no one's going to tell you what to do. Great. The TPO channel is for you. And why stop at being a broker? Get a warehouse line. Pricing's better. Go be a correspondent. In fact, go get an underwriter. It gets even better. Go, if you really want to be an entrepreneur, start your own lender and go down that path. So we help people that want to do that. If you don't want to do that, you want to focus on your thing. You love your processing team. You love your retail team. You love your branch manager. You can get your own dedicated underwriter. You can have your own little mini business without having all the headache of owning the business, like a franchisee, except not so cookie cutter like McDonald's. That's our retail channel. So we have a saying, we're built by originators for originators. We serve originators however they want to be served. Anyone saying that one is better than the other, that's great. Say it. I want you to be proud of what you do. We just think that it's such an abundant group of originators out there that we're trying to serve all 3. And it's very hard to be a multi-channel lender, but we're trying our best, and we have really good retention rates in our channels, and we feel like we're positioned very well for the rest of this year and beyond.
KP, as always, outstanding perspective. Love hearing you talk about the industry. Thanks for joining us this week.
Thanks for having me. Appreciate it.
All right. To all our attendees, thank you for taking some time out. We're here every Tuesday live, 2 p.m. Eastern, the last week of Mortgage Today. Also upload all these videos to our YouTube channel and release them as podcasts as well, where I know a lot of you view or listen that way as well. So until next week, have a great rest of the week, everyone. Take care.